January 1st, 2026, a surveillance framework went live in 48 countries, and it proves, accidentally, why Bitcoin works. CARF, Crypto Asset Reporting Framework. Every exchange, Coinbase, Binance, Kraken, now auto-reports your balance, transactions, and tax ID to your government annually. No warrant. The FATF travel rule stamps your identity on every withdrawal. The on-ramp is now a panopticon. But here's the design flaw in their system. They can only surveil the intermediaries. Bitcoin's base layer doesn't have a CEO to subpoena. Self-custody doesn't file reports. The protocol is still pseudonymous. CARF just proved why not your keys, not your coins isn't a slogan. It's operational security. Before I break down exactly how this surveillance system works, I need to know where you're watching from. Drop a comment. What city? What country? Do you use centralized exchanges or do you self-custody? This matters for what I'm about to show you. And if this opening has you realizing that 2026 is the year Bitcoin privacy changed, hit that like button immediately. Because what I'm showing you next is the exact mechanism, backed by OECD documents, EU directives, and FATF recommendations. Subscribe with notifications on. The next 20 minutes explain CARF, DAC 8, and the travel rule in detail. Let me start with CARF, the Crypto Asset Reporting Framework. This is the OECD's new global standard, and as of January 1st, 2026, it's law in 48 to 67 jurisdictions. What is CARF? CARF requires reporting crypto asset service providers, RKASPs, that's exchanges, brokers, custodial wallets, to collect and report. They must provide detailed information about their customers to tax authorities. What gets reported? Personal identification, full name, address, date of birth, tax ID number, TN, country of tax residency. Account balances, total value of all crypto assets held as of December 31st each year. All transactions, buys, sells, swaps, transfers. Transaction values, aggregate amounts by transaction type. Who reports? Any platform that facilitates exchanges between crypto and fiat or between cryptocurrencies. It also includes platforms that handle transfers of crypto assets on behalf of customers. This includes Binance, Coinbase, Kraken, OKX, and any licensed exchange in a CARF jurisdiction. When does reporting start? Data collection began on January 1st, 2026. First reporting deadline is 2027, covering the 2026 tax year. First automatic exchange between governments will also occur in 2027. Which countries are in? As of February 2026, 48 to 67 jurisdictions are committed. Includes UK, EU, all 27 member states via DAC 8, Australia, Singapore, Hong Kong, Japan, South Korea, Canada, UAE, Switzerland, Cayman Islands, and Jersey. United States, committed to implement, but delayed to 2027 or 2028. The DAC 8 connection. The EU implemented CARF through Directive 2023/2226, known as DAC 8, passed October 2023. Implementation, January 1st, 2026. Covers all 27 EU member states. DAC 8 and CARF are functionally identical. DAC 8 is the EU's version of the OECD's CARF standard. How it works in practice. Let's say you're a German resident using Binance. Binance collects your tax ID during KYC. Throughout 2026, Binance tracks your Bitcoin balance on December 31st, 2026. They track every buy, sell, swap you made, and every deposit and withdrawal. In 2027, Binance automatically sends this data to the German tax authority, Bundeszentralamt für Steuern. The tax authority cross-references it with your tax return. If there's a mismatch, you get audited. No court order required. This is automatic exchange of information. It's not triggered by suspicion or investigation. It's annual, systematic reporting, just like how banks report interest income. The goal, according to OECD, to preserve the gains achieved through the widespread implementation of the Common Reporting Standard. They aim to address the risks posed by crypto assets in relation to tax evasion and avoidance. Translation. Governments don't want people using crypto to hide wealth from taxation. If you're realizing that starting January 1st, 2026, every Bitcoin transaction you make on an exchange is being logged and reported, hit that like button. Comment below, did you know about CARF before watching this? Most people don't, that's the problem. Subscribe because next I'm showing you the travel rule, which tracks Bitcoin even when you withdraw to your own wallet. 0.5.00.08.00. Now, let me explain the travel rule. This is separate from CARF, but works alongside it to create comprehensive surveillance. What is the travel rule? FATF Recommendation 16, updated in June 2025, requires virtual asset service providers to collect information. Exchanges, brokers, and custodians must share details about the sender and recipient of every crypto transaction above a certain threshold. Thresholds by jurisdiction. United States, $3,000. EU and UK, $1,000 or 1,000 euros is common. But under the transfer of funds regulation, many EU transfers have a zero threshold. Switzerland is the strictest. They require data for all transactions with no minimum. Many others use a $1,000 limit. What information must be shared? For transactions above the threshold, they need the originator's full name and account number or wallet address. They also require the sender's physical address or their date and place of birth. For the beneficiary, they must collect the full name and the account number or wallet address. The self-custody problem. Here is where it affects hodlers. When you withdraw Bitcoin from an exchange to your own hardware wallet, the exchange must collect information about the destination wallet. You must verify it is your wallet and provide proof of ownership, such as a signed message or a liveness check. The exchange links your identity to that specific wallet address. This information is stored for at least 5 years and can be reported to authorities. What happens? If you refuse, per implementation in several jurisdictions, the exchange sends you 2 reminder requests. After 60 days of non-compliance, your withdrawals and trading are blocked. This was confirmed in January 2026 for several EU jurisdictions. The sunrise problem. Not all exchanges in all countries have implemented the travel rule yet, creating compliance chaos. A VASP in a compliant jurisdiction might send data one way to a non-compliant one, or transactions might get blocked entirely. Exchanges use technology like Nota Bene, TRM Labs, or Chainalysis Travel Rule to create encrypted messaging layers. The privacy implication. Once you withdraw Bitcoin from Binance to your ledger, Binance knows that wallet address is yours. If you later send from that wallet to another exchange, that exchange can trace it back. Chain analysis firms like Chainalysis and Elliptic can link your identity to that entire address cluster. Your anonymous self-custody wallet is now tagged with your real identity at the entry point. If you're understanding that withdrawing Bitcoin from an exchange to your own wallet doesn't mean it's completely private anymore, hit that like button. Comment. Do you self-custody Bitcoin? Did you know your withdrawal address is linked to your identity by the exchange? Subscribe, because next I'm showing you what happened to privacy coins, and it reveals the agenda. Now let me show you what happens to actual privacy in this system. Spoiler, it's not allowed. The delistings, Binance on February 6th, 2024, delisted Monero, Zcash, and Dash. The official reason was regulatory requirements and evidence of unethical conduct. The real reason is they cannot comply with the travel rule. Monero uses ring signatures and stealth addresses, making it impossible to trace the sender and recipient. The FATF travel rule requires exchanges to identify both parties, which is mathematically impossible with Monero. OKX Korea delisted Monero, Dash, Zcash, Horizon, and Super Bitcoin in 2020 for the same reason. Coinbase UK delisted Zcash in 2019 due to pressure from the United Kingdom Tax Authority. Kraken has also removed privacy coins in multiple regions, including the United Kingdom and parts of Europe. The pattern. Any cryptocurrency that actually provides privacy gets delisted from regulated exchanges. This is because they cannot comply with KYC and AML requirements or trace transactions for the travel rule. Regulators explicitly forbid them under the EU anti-money laundering regulation for 2024 to 2026. What this reveals. The goal isn't just transparency for tax compliance. The goal is eliminating financial privacy. If privacy coins are banned because they cannot be surveilled, what does that tell you about Bitcoin's lack of privacy on exchanges? Bitcoin has some privacy features like CoinJoin, the Lightning Network, and Taproot. But exchanges and chain analysis firms now flag Bitcoin that touches Wasabi Wallet, Samurai Wallet, or any mixing service. If your Bitcoin touches these, deposits to exchanges may be frozen or require proof of source documents. The 2024 to 2026 policy sees Binance, Coinbase, and Kraken using chain analysis to score every deposit for risk. They flag transactions from mixers or sanctioned addresses and freeze accounts demanding an explanation. This is documented in user reports and confirmed by the companies in their compliance statements. If you're realizing that exchanges have effectively banned actual privacy while keeping the illusion of Bitcoin's pseudonymity, hit that like button. Comment. Have you ever had a deposit frozen for suspicious activity or been asked to prove your source of funds? Subscribe, because next I'm showing you the market's reaction, and it's a supply shock. Now let me show you what happened when these rules went live. Bitcoin holders are voting with their wallets. The data for January and February 2026, Sentiment reported in early February 2026 that 19,162 BTC left exchanges in just 7 days. This has been described as the Bitcoin exodus. Glassnode and CryptoQuant show consistent net outflows from exchanges throughout January and February. This is occurring despite bearish price action, with Bitcoin at approximately $68,000. down from its $124,000 peak. Exchange reserves. There are currently 2,480,000 BTC on exchanges, according to CoinGlass data from February 16th, 2026. This represents a 5-year low, down from approximately 3,300,000 BTC during the 2021 peak. Why the outflow? People are moving Bitcoin to self-custody specifically because of the CARF reporting that started on January 1st, 2026. They're also reacting to the travel rule tagging of withdrawals and the fear of frozen funds or forced KYC upgrades. The irony: by creating oppressive surveillance on exchanges, governments are accelerating Bitcoin's move to self-custody. This is actually making the network more sovereign and harder to control. The supply shock thesis. Liquid supply on exchanges is only 2,480,000 BTC, and it is shrinking. New issuance is just 450 BTC per day post-halving. ETF and institutional demand are absorbing more than the new supply. Long-term holders now lock up 14,400,000 BTC, which is 72% of the total supply. Every Bitcoin that leaves exchanges reduces the tradable float, creating massive scarcity pressure. If you're understanding that government surveillance is ironically pushing Bitcoin into more sovereign hands, hit that like button. Comment: are you part of the exodus? Have you moved Bitcoin off exchanges recently? Subscribe, because next I'm addressing the elephant in the room. Is Bitcoin still private? Now let me be very clear about what is and isn't private with Bitcoin in 2026. What CARF and the travel rule do not control. Bitcoin's layer 1 protocol. There is no KYC built into the Bitcoin code. There is no government access to the blockchain itself. Transactions remain pseudonymous, using addresses rather than names. Self-custody remains sovereign, your keys, your Bitcoin. Peer-to-peer transactions from one private wallet to another are not reported. What Satoshi designed. The Bitcoin white paper from 2008 stated the network is robust in its unstructured simplicity. Bitcoin was designed to be decentralized, with no single point of control and permissionless, so anyone can run a node. None of that changed in 2026. What did change are the on-ramps and off-ramps. Exchanges, custodial services, and regulated brokers are now surveillance checkpoints. But the Bitcoin network itself is unchanged. The self-custody reality. If you buy Bitcoin peer-to-peer without an exchange and hold it in your own hardware wallet, CARF and the travel rule do not touch you. Your Bitcoin is as private as it was in 2013. The practical problem: most people need to buy or sell Bitcoin for fiat currency, which requires an exchange. Those entry and exit points are now fully surveilled. The long-term hodler strategy: if you are accumulating Bitcoin for 10 to 20 years and don't plan to sell, your holdings are known at purchase, but future moves are private. The Lightning Network. Off-chain Bitcoin transactions via the Lightning Network are not currently captured by CARF or the travel rule. This is a privacy layer that is still functional, though the initial on-chain setup remains traceable. If you're understanding that Bitcoin's core protocol is still sovereign, but the intermediaries are not, hit that like button. Comment: are you willing to never sell back to fiat to maintain privacy? Or do you accept surveillance as the cost of liquidity? Subscribe, because the final section gives you practical steps, what you can actually do in 2026. Let me give you practical guidance for navigating Bitcoin in the surveillance era. Option 1, accept the surveillance. Use regulated exchanges like Coinbase, Kraken, or Binance, and accept that your data is reported via CARF. Benefit from regulatory clarity and easy liquidity while maintaining clear legal standing. Option 2, maximize on-chain privacy. Use tools like CoinJoin and Wasabi Wallet or the Lightning Network for off-chain moves. Consider peer-to-peer trading on decentralized platforms like BISC to bypass exchanges entirely. Option 3, offshore structures. For high net worth individuals, consider relocating to zero-tax jurisdictions like the UAE, El Salvador, or Singapore. Option 4, wait for better technology. Privacy tech is improving with Taproot and Schnorr signatures already making scripts more private. What not to do? Do not evade taxes illegally, as the penalties are severe and the data is already being reported. Do not panic, sell. CARF and the travel rule are surveillance, not confiscation. Your Bitcoin is still legal and yours to hold. The philosophical choice comes down to privacy versus convenience and sovereignty versus liquidity. Most people will choose convenience. That is why these rules work. The Bitcoin maximalist. Take, self-custody, is non-negotiable. Fiat is the exit scam, not Bitcoin. Based on everything you've learned, which path are you choosing? Comment below. Accept surveillance, maximize privacy, or relocate? Hit that like button if this breakdown gave you clarity. Subscribe for the final summary. January 1st, 2026. CARF went live in over 48 countries. Every exchange now reports your identity and balance. The travel rule tags your identity to every withdrawal. Privacy coins like Monero were delisted because they actually work. And the market's response? Over 19,000 BTC left exchanges in 1 week. Exchange reserves are at a 5-year low. The reality is that Bitcoin Layer 1 is still sovereign, but exchanges are now surveillance checkpoints. The choice is yours, convenience and surveillance, or privacy and sovereignty. Most people will choose convenience. That is how surveillance succeeds, by making the alternative too difficult. But for those who understand what Bitcoin was designed to do, these rules just make the on-ramps visible. Not your keys, not your coins. Not your data, not your privacy. One last time, drop a comment. Tell me where you're watching from, and if you're moving to self-custody. Hit that like button and subscribe for every major Bitcoin development in 2026. The surveillance state arrived, but Bitcoin is still here. Thanks for watching. See you in the next one.